Bloomberg Surveillance, Early Edition, with Francine Lacqua.
Good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London, and here's what's coming up on today's program. Risk on, Europe extends gains after Hong Kong shares led gains in Asia. Traders await today's Fed minutes as former Fed official Bill Dudley says a U.S. recession is pretty likely. Now, chips down, China is said to be moving away from massive spending on semiconductors as a resurgence of COVID strains the nation's finances. Plus, Kevin McCarthy loses 3 rounds of voting to become U.S. Speaker of the House, foreshadowing deepening legislative gridlock in Washington. Now, first thing is first, so let's check in on the markets. A lot of focus, of course, is what's happening in China. That's giving a nice little boost to certain sectors here in Europe. European stocks gaining some 0.8%. It's also boosting some of the S&P futures over in the U.S. Look at what's that doing to the U.S. 10-year yield, although I would look at political gridlock and try to see whether there's longer-term market implication in the U.S. 3.6958 is that yield on the 10-year. And then the other big question, of course, is what happens to oil. Yesterday, WTI was down 4%. Today, it's continuing when it's moved downwards, 75.22. This is because of a number of factors, including the risk of a U.S. recession. The question is, what does it mean for OPEC Plus, especially for Riyadh? As at the beginning of the year, they usually try and balance the budget and see what happens in the next 12 months. Now, European stocks so far had a strong start to the year, signaling a growing risk appetite amongst investors. So joining us now to talk about the future, what a treat for January the 4th is Bloomberg's Markets Live editor, managing editor Mark Cudmore and Mike Bell, JPMorgan Asset Management, a global market strategist. So thank you both for joining us. Mark, you've had some great calls over the last 12 months. What do you think will go wrong and what do you think will go right in the next 6 months?
Well, there'll be a lot that will go wrong. That's what I'm going to assume is going to be the case. I kind of make every conviction quite humbly made. I think there's probably 2 big risks. I think, first of all, last year everyone was obsessed by inflation, but this year the bigger call that's going to matter more is growth. I think it's pretty much consensus that inflation is going to come lower, so it's more about how much it collapses or whether it kind of comes lower at too high a level. Well, then that'll be more of a growth call. So when I'm looking to where I'm going to be most wrong in 2023, it's on the growth call. What's my base case? My base case is that the US goes into recession in the second quarter and it ends out being deeper and more prolonged than is priced.
Mike, before I go to Mike, thank you for that, Mark. We're just getting some Euro area PMI. This is services for the month of December. That PMI 49.8. It's actually better than expected, or better than the preliminary 49.1, but anything below 50, of course, is still a contraction. So, Mike, what do you think could go right for the Euro area in 2023?
I think the European stocks, the key thing is they go into this year having been pretty beaten up in 2022. Which is the case, actually, when you look pretty much around the world. So I think the sort of positive start we're seeing for 2023 is that markets know the bad news is coming in terms of the economy, price that in 2022, and are now starting to look ahead and say, well, actually, what's 2024 going to look like? We're going to have a recession in 2023. 2024 might be the year of recovery and start to price that in 2023.
So, Mike, what is the biggest, if there's anything that you do with conviction, and I know we're expecting volatility, Mike Bell, but is there something that you'd be buying right now in the expectation that, other parts of the markets haven't latched onto it yet?
I think the US banks look pretty attractive. They're down about 30% in 2022. So to me, that suggests that they know there's some economic hit coming for the economy. But I don't think it's going to be that bad. I don't think we're going to see a financial crisis. About 95% of Americans are on long-term fixed-rate mortgages now. So it's not going to be like it was in 2008, where higher interest rates caused a mass wave of forced sellers. There's far fewer subprime mortgage borrowers. The banks are much better capitalized. So I don't think you're going to get a financial crisis. And with banks down 30%, that looks pretty attractive, I think.
Mark Cudmore, if you hear me, because I know we're having a couple of technical difficulties, but if you can hear me, what is I don't know whether there's an entry point, and we're seeing a couple of calls from some of the big Wall Street banks, like entry points, for example, in the S&P. But is there a data point that you're waiting for to say, like, actually, this is a buy signal?
That's a great question, Francine. I can hear you well now. The god on my ear has disappeared, thankfully, for the last time it was distracting me. I think when you talk about what the entry point is, it's really about your call about how low US stocks will go. So if you're very bullish, you kind of think, you know what, no point waiting, let's get in now. I am in the camp that US stocks will break their 2022 lows. I expect that to happen around the second quarter of this year, but obviously that timeline will continue to change. I'm very open anytime in the first 6 months, maybe even the first 9 months. I think that once we get down to that towards 3,300 level, that kind of thing, we price in a bit more of a recession a bit more seriously, then you're going to have to assess how quickly the Fed will react. My base case narrative is that the Fed won't be as quick to cut as the market thinks, even as inflation is coming down, even as recession is coming, because this is a Fed-engineered recession. So they want to see growth slow down rather than panicking. So as for the entry points, I think it will be, like everyone is kind of saying, when the Fed starts really panicking about the markets and saying that, hey, no, wait, we want to ease our way back out of this. We want to re-stimulate animal spirits. I just think that entry point is going to come later than much of the market. And that's why I think US stocks make a new low in the first half of this year.
Mike, I mean, how hard, Mike Bell, is it at this point, given what Mark's beliefs are, to say, look, this is the right time to get into US equities?
The precise timing is always hard, but we did a fascinating study. We looked back to the post-war period and looked at every time the S&P 500 was down 25%. How often were you higher a year later? And there were only 2 occasions when you weren't higher a year later. So we went down 25% by the end of September last year. And so the vast majority of the time, 12 months after that, stock markets have been higher. And so, look, it may be some of those times you did go a bit lower before you ended up higher a year later. But if you've got a 12-month horizon, we think that it's a pretty attractive time to be owning stocks.
Mike Bell, I have a viewer question. So thank you, first of all. Happy New Year to all of our viewers and listeners, and keep on sending those questions. Mike Bell, this person's writing in saying, look, if the threat of Putin was to disappear tomorrow, what is the first EU sector that you would buy?
Probably industrials or the banks, the sort of deep cyclical value stocks in Europe.
Mark, I don't know whether there is a belief that from here one of the biggest equation is energy. And I know this was a tough question, but again, is there something, are we now have we gotten used to the fact that this war could go on for a long time? Like, what does it mean for the markets if there was some kind of resolution or escalation?
I think if, as Mike says, if there was a sudden resolution, and that's obviously quite a big if, then I think you've got to be buying these cyclicals. And European stocks are generally discounted, and I think there is major upside there. You've also got to look at those countries that have been most squeezed by the energy crisis. And I think, Germany might be a good name, where there's still a risk premium for what happened around their energy infrastructure. So I think the DAX might be a good story there. And they have a lot of those cyclicals, again, exposed to the positive China story. So I think that might be a good one. If there's an escalation, you've both got a worry about proximity, about generally the distance. So I think, again, Germany might be most vulnerable, some of those ones in this eastern count. And you've also got those ones that are most going to be squeezed by another spike up in energy. Because, remember, the structural energy crisis in Europe is not resolved. The short-term one of this winter, we appear to be getting through this winter, okay? The short-term energy crisis, we're getting through the worst of it. The structural one is not resolved, and those countries that are at the forefront of that will remain vulnerable to any escalation.
Mike Bell, how do you play China right now? So China is resuming this residential real estate funds. It's trying to support the economy. Again, is it a good time, or how do you play the Chinese markets in 2023?
We're pretty bullish on China. I mean, I think it's fascinating that if you look at the return we've seen since the end of October, Chinese stocks are up about 35% or so, but they're still down 50% from where they were at the peak back in 2021. So there's still a lot of bad news priced into China. Obviously, they've gone up a little bit on this hope that China's going to be able to move past zero COVID, and there may be some bumps on the road there. But ultimately, we do think by the end of 2023, China's no longer going to be worrying about COVID, and that's pretty bullish for Chinese stocks that are still down 50% from the peak.
All right, thank you both for joining us. Mark Cudmore there, of course, from our Bloomberg MLive team. He manages it. And Mike Bell, JPMorgan Asset Management Global Market Strategist, joining us this morning. Now, coming up, China announces a range of measures to help its slowing economy, including aid for too big to fail property developers. We'll have plenty more on that story from the ground next. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, Bloomberg has learned that China is considering steps to further support some of its too-big-to-fail developers. That's as the ongoing property downturn has led to a liquidity crunch. Now, the aid could include equity financing and loans, enabling creation of real estate investment trusts and driving acquisitions. Well, joining us now is Lulu Chen, Bloomberg's investing and real estate team leader in Hong Kong. Lulu, good morning. What's prompting the move to actually support developers?
Well, China wants to avoid a disorderly collapse of the property market that could spill into a larger financial contagion crisis. You can see the November sweeping basket of policy supports as a tone-setting milestone. Back then, China issued a 16-point measure support plan. And today, we're seeing more implementations of policy support, including what we've just reported that the Financial Stability Board has urged banking and securities regulators to help improve the balance sheet of systemically important banks, provided that they don't have any auditing issues. And then the other part where they resumed approval of PE funds for residential property developers.
So meanwhile, Chinese officials are also discussing easing a ban on Australian coal. So what's driving that change?
I think that's the result of improving relationships between China and Australia. Also, China's foreign ministry, the overall stance has softened ever since China's leadership change. The other important aspect to consider is China's desire to secure its energy. So importing Australia coal would help secure that.
So, I mean, there's so many stories, and I know you've also been working, for example, on something with and in some of the big companies to really try and figure out what happens to them in the next 12 months. What do you think will be the most significant change for Chinese companies?
Yeah, when you put all the pieces together, you're starting to see a pattern. And I think for this week, the number of positive stories coming out of China just paints a picture where policy regulators are finally softening their stance and ready to refocus on the economy. The improvements for the tech sector and also property sector all play into that.
Thank you so much. Of course, Bloomberg's Asia Investing and Real Estate team leader, Lulu Chen, there on the various big news coming out of China. Now, coming up, UK food inflation jumps to historic levels, but wider store prices rises moderated. We'll discuss the prospects for the UK economy next. This is Bloomberg. Now, the British Retail Consortium says food inflation has accelerated strongly to a record high last month, with retailers warning of another year of elevated prices. Now, for more, we're joined by Bloomberg's Lizzie Burden. Lizzie, if you break down the data for us, I mean, it's an ugly picture for 2023.
It really is. The British Retail Consortium says food prices rose 13% in December. And we also had data from Kantar this morning showing that £12 billion was spent on groceries in December. That's the first time ever this has happened. And what it is, it's not people buying more, they're spending more because of inflation. And if you take the case of the lowly mince pie, 19% more was bought in terms of mince pie sales, but not in terms of volumes. They barely moved. And actually, the BRC says that prices are going to go up again in April because the government's support for energy bills is set to expire. Now, to put this into real-life context, there was a really fascinating interview in the British Medical Journal with the president of the Royal College of Paediatrics and Child Health. And she said that cases of children with rotten teeth in the UK had increased because for more families, toothbrushes are a luxury item. The quality of food that they can afford to buy has worsened. So these aren't just numbers on a spreadsheet. It has real-life consequences.
Yeah, I read, the fact that, children toothbrushes are seen by some families as luxury items is just heartbreaking. That was one of the first things I read this morning. And we should absolutely always remember that. This means that Rishi Sunak has a lot to do, and yet he's trying, I think he said, getting so much pressure from lawmakers, from his party, to actually have a positive spin, that he focuses on education instead of maybe the pressing issues.
Exactly, and he's making a speech this afternoon where he's expected to set out his vision for 2023, and curiously his office has chosen to focus all the previews on an announcement that he's going to pledge that children in all English schools until the 18 need to learn some form of maths. Now, you might think, as you say, that this is a positive spin because education's a big priority for him. He owes his success, he says, to his education at the famous public school Winchester. It seems like he's trying to turn his political Achilles heel into an asset. But it risks looking tone deaf when you've got strikes almost every day and an NHS in crisis.
And then we also have consumer borrowing data a little bit later. So what are you expecting from that?
Yeah, that's including mortgage approvals data. It's from the Bank of England, and they're expected to fall from 59,000 in October to 53,000 in November. This is because of the inflation we've just been talking about and the higher interest rates. And the knock-on effect of that is Bloomberg Economics reckons you're going to get house prices dropping 10% this year. And the knock-on effect of all of this is for the recession that the Bank of England says we're already in. You've got 4/5 of mortgaged households in the UK on fixed rates. They're going to have to be renewed on much higher rates. People are going to get a nasty surprise, and it's going to dent demand in the economy probably, which will stoke this recession.
Okay, Lizzie, thank you so much for all of the update. We have a big news flow, of course, out of the UK today. Lizzie Burden there with the very latest on some of the UK stories we're covering. We'll also continue our coverage of all top UK stories every Thursday, 9:30 a.m. in our half-an-hour special right here on Bloomberg TV. Now let's get straight to the Bloomberg First Word News. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. The EU is moving towards a requirement for masks and pre-flight COVID testing on travellers from China. A Commission spokesman says a strong majority of countries back the test, which would go beyond what EU health authorities recommended last week. Any change will need to be approved by EU ambassadors who do meet later today. Now, China is pausing massive spending aimed at building a chip industry to compete with the US. Sources tell Bloomberg that Beijing is reining in investment as a nationwide COVID surge does strain finances. Officials are said to be discussing alternative ways to assist homegrown chip makers, such as lowering the cost of semiconductor materials in a move away from costly subsidies. Now, Bloomberg has learned that Chinese bureaucrats are discussing plans to resume some imports of Australian coal. The potential move comes after a ban of more than 2 years as relations do improve between the nations. China implemented an unofficial pause on imports in late 2020 as hostilities between Canberra and Beijing did escalate, particularly over calls for an independent probe into the coronavirus. And Chinese regulators have approved a plan by Jack Ma's Ant Group to raise $1.5 billion for its consumer unit. The green light is a sign of progress in the fintech firm's government's ordered overhaul, which will leave Ant controlling half of its shares after the deal. The University of California is investing $4 billion in the massive BlackRock real estate income trust. The fund has faced higher redemptions in recent months and been forced to limit withdrawals. Blackstone sweetened the deal by earmarking a $1 billion backstop to help the university get a minimum annualized return of 11.25%. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Francine.
Leanne, thank you so much. Leanne Gerrans there with the very latest on the top news. Now, stocks actually advancing in today's trading session. So let's look at Europe, but really continuing some of the risk-on mood that we saw in Asia. Now, stocks advancing, U.S. futures also seem to be focusing on the favorable news reports from China, but also data from Europe that's boosting risk appetite. If you look at what is giving a boost here in Europe, we had this unexpected slowing of French inflation, and that seems to be adding to signs of easing price pressure in the euro area. Also, we had news that China is considering further support for property developers. That was really seen as a positive. The dollar is the big story that we need to keep an eye on, and of course what that means not only for euro dollar, but for example, some of the emerging markets that are so dependent on the price of oil. We have the Bloomberg US dollar index. We could have shown you euro dollar for the moment, 1,249. Now, separately, there's quite a lot going on with oil. It's falling further today after the biggest drop in more than a month yesterday. The question, I think, is now, what does OPEC Plus do? So we're January. A lot of the OPEC Plus countries, including Saudi Arabia, that potentially is probably the only country that could add more oil on the markets, needs to balance its books. Does it try and convene an emergency session to see what it can do? Now, coming up, third time isn't the charm for McCarthy. We discuss his failed attempt to be nominated for U.S. House Speaker. That's coming up next, and this is Bloomberg. Risk on. European stocks and U.S. futures extend gains after China support measures and slowing French inflation drive optimism, while traders await Fed minutes as former Fed official Bill Dudley says a U.S. recession is pretty likely. Now, chips down, China is said to be moving away from massive spending on semiconductors as the resurgence of COVID strains the nation's finances. Plus, Kevin McCarthy loses 3 rounds of voting to become U.S. Speaker of the House, foreshadowing deepening legislative gridlock in Washington. Well, good morning, everyone. Welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. So, Republican leader Kevin McCarthy failed to win a majority to be House Speaker in 3 rounds of voting after a small group of GOP hardliners rebelled. That's despite McCarthy spending the last year courting Republican conservatives. Now, it's the first time in a century that the House has not elected a Speaker after 1 round of balloting. Well, joining us now is Rosalind Matheson, Bloomberg Senior Executive Editor for Government. Ros, thank you for joining us. We haven't seen this in 100 years. First of all, how unexpected was it? And what does it tell us about the state of the Republican Party?
Well, if you look back, you can see actually there's been a trajectory about McCarthy with this far-right wing of the Republican Party for a while. They think that he's been too supportive for too many years of Democrats spending in a freewheeling fashion. This is really, in an essence, payback time for him. They think he got too complacent about being Speaker. In fact, he'd moved into the office before the votes were even held. And what they're saying is, hang up, no, we're going to become a bloc here, and we're going to demand our own set of things if you're going to become Speaker. And they're really staking their ground on this. So what it tells us is several things. One is that the Republican Party is incredibly fragmented, even more so than we've seen before, and possibly will become really fragmented in the run-up to the 2024 election. It also shows it's going to be a problem getting anything done in Congress in the next 2 years also, no matter who ends up being Speaker.
But does it shift the Republican Party to, more to the right?
Well, we've seen that trend for a while, of course, under the presidency of Donald Trump, who's now going to be a Republican candidate, he said, for president in 2024. And even if he doesn't succeed, you can see the after effects of his administration lingering through the Republican Party. You see increasing populism. You see Republicans who are dug in against spending, particularly when it comes to raising the debt ceiling. That will become more problematic. So what you're really seeing is a fundamental tussle in the Republican Party. Do they go the way of Donald Trump? Do they go the way of moderates? It seems increasingly unlikely they're going to stay in that kind of centre ground.
So does it give us also an idea of who could be the Republican candidate for 2024?
Well, that is the real question. Of course, we don't know yet whether someone like Ron DeSantis is going to throw his hat into the ring. Of course, he is also ultra-conservative and from that part of the Republican Party, arguably more presentable, perhaps, to voters than Donald Trump is. He's been very charismatic in Florida and successful in his policies, perhaps wrapped up in a package that can be more palatable for voters. Either way, you're probably going to see a candidate come from the right in the Republican Party in 2024.
So, Ross, the gridlock, actually, what does it mean also for Biden and what he's trying to pass through Congress?
Well, it's going to be very difficult to begin with because, of course, the Republicans have a very small majority in the House itself. It was going to be gridlock either way, but what we can expect is even more gridlock on top of gridlock, because if McCarthy doesn't have the ability to negotiate on behalf of the Republican Party as a whole and is negotiating all the time within factions of his own party, can he be an honest broker for the Democrats to get things done? If he promises the Democrats, I'll get this through with you, is there any guarantee? No. So it's going to be very, very difficult for the Biden White House to get any anything done in this kind of scenario.
So, Roz, I mean, zooming back, the most important event, of course, over the next 5 years is probably what's happening with in the U.S. election 24. Do you see if the Republicans go more towards right wing, does it mean that Democrats go more left wing?
Well, that is the challenge. You've seen tendency really as people go right as they bring others with them because, of course, you're playing for that centre vote.
Yep.
And that really is the sort of the core vote that needs to be secured to get the presidency in 2024. You can see that's why they wouldn't be putting up a far left candidate, for example, if Joe Biden decides not to run. It's really going to be more about the centre and the centre right.
Thank you so much, as always, Rosalind Matheson there, Bloomberg Senior Executive Editor for Government. Now, FTX founder Sam Bankman-Fried has also pleaded not guilty to criminal charges in the U.S. District Court of New York and will face trial in October. For more on all of this, we're joined by Bloomberg crypto reporter Emily Nicole. Emily, was it a surprise, actually, that Bankman-Fried, good morning, first of all, was it a surprise that Bankman-Fried entered a not guilty plea on all counts?
Good morning, Francine. So no, it wasn't a surprise. We were expecting him to enter a plea that's not guilty. But it is kind of surprising in that his colleagues pleaded guilty to their charges of fraud, both Caroline Ellison and Gary Wang. So on that front, Sam is really sticking his neck out and saying, I didn't do this. However, what this does mean is that he'll get given additional time now with his team to discover what the prosecutors might actually have against him in terms of evidence and potentially build a case off that.
So what terms, what terms did the hearing actually end on? Like, where are we?
So we now have a very, very long time to go, and there will be a trial later on this year in October. And as part of the arrangements that were agreed at the hearing, there are now several more additional bail conditions set against Sam. So he's, for example, he's not allowed to start a business. He's not allowed to make any additional transfers up to a certain amount of US dollars. And also the judge wanted to make sure that he can't touch any assets that are to do with FTX or Alameda. So he put some additional conditions in there because, as we found out earlier last week, reported by Bloomberg, that there are prosecutors looking at certain wallets attached to Bankman-Fried and whether or not transactions have continued to be made by those wallets.
So what's the timeline, Emily, of what comes next?
So the trial will be in October. That's the date that's been set. It seems very far away to us, but that's a really long time that now the two sides have periods to discover exactly what cases they want to make. And the case could even go longer than that. Some are expecting the trial could happen even into early 2024. And until that date, we'll have a bunch of different things happening between the two sides. And obviously the bankruptcy case will continue on from there.
All right, Emily, thanks so much. As always, our crypto reporter there, Emily Nicole, joining us on the very latest with Sam Bankman-Fried. Now, we're also getting some data out of the UK. The Bloomberg terminal is giving me the data for UK November mortgage approvals. Now, it's gotten, or we were actually expecting a 53,000 approval. We actually got 46,000. I don't know whether that's having a huge impact on what we're seeing overall. For example, for sterling, we had a pretty bold call from Van Ram a little bit earlier on. He's expecting sterling to actually finish on a higher because of a number of things, and he's expecting actually for investors to come back into the UK in the next couple of months. So for the moment, that mortgage approval rating 46,075 instead of the estimated 53,000. So it's a worse number than expected. Coming up, new year, new gym membership. Well, we speak to Humphrey Cobbold, the Chief Executive Officer of PureGym, on whether the UK's cost of living crisis and inflation is impacting his business. That's next, and this is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, the UK is facing a confluence of headwinds, including a cost of living crisis, spiraling inflation, and risk of a long recession. It's hitting consumers particularly hard, painting a pretty bleak picture for discretionary spending on things like gym memberships. Now, will the sector miss out on the usual New Year spike in memberships in 2023? Well, joining us now is Humphrey Cobbold. He's Chief Executive of PureGym, the UK's largest gym operator. Humphrey, thank you so much for joining us. First of all, how many people are deciding to now go to the gym after maybe the month of festivities in December?
Well, yeah, good morning, Francine. Good to see you again. Look, the reality is we don't quite know yet. We sit as we stand currently with just around 1.3 million members in the UK, and we hope that we'll get several tens of thousands, indeed a couple of 100,000 joining up over the next 2 or 3 months. That's what we're hoping for, and that's what we're doing. And I do believe that British people understand the need for good health and well-being. We look after people very well in our facilities. We offer great value and a high-quality product, lots of flexibility. People don't have to sign up to a 12-month contract. So if their financial situation changes, they can alter their behavior later if they want to. And we're working very hard to serve people in that regard.
Yeah, so if you look at the next 12 months, and it will be hard, we're seeing the price of inflation, the cost of living crisis increasing. You also have quite a lot of strikes, which makes it difficult for people to get to A to B. Like, what's your biggest concern over the next 6 to 12 months?
Well, I think all of the above, Francine. We're concerned about consumer spending, and hence we've launched memberships which are lower priced, off-peak, saver memberships to allow people to have access if they can flex their time a little bit to make that more affordable. I'm concerned about travel patterns. That impacts us particularly in the UK and into central London, of course. And I'm concerned about inflation in cost as well for us, of course. And we're working very hard to mitigate the impact of those, and especially energy costs in particular.
Humphrey, I think during COVID, or certainly during lockdown, you had about 30% of your members leave. Have most of them come back? How are gym habits changing?
Yeah, about 2/3 of those are back already, and we've seen steady further progress. That progress did slow up a bit through the back end of last year. That's not entirely surprising given the highly disrupted September and October we had with all the concerns around mortgage rates and the recognition of the impact of the cost of living issues on people. But in general, people are coming back. The good news is that we're seeing higher utilization than before. People who are back are using the gyms a lot to look after their health and well-being. And we're also getting very strong net promoter scores, positive feedback from members about the quality of the product we're giving to them. So I'm hopeful, I'm an optimist for the future, but we're going to have to work hard to serve people well in the environment that we're in. There's no question about that.
So how difficult is it to find staff, and do you have to pay them more than you did last year?
We are increasing pay to staff. Of course we are. We provided further transitional relief to people last year to help with the cost of living crisis, and in particular with a focus on some of our lower paid staff. That's absolutely the right thing for businesses to be doing at the current time. And of course, it is challenging finding staff as well. I think we're well set up in that regard. We're a strong brand with good career prospects for people who join us. So thus far, we've been able to meet most of our needs on staffing, but we'll remain ever attentive on that. Our people are an incredibly important part of the proposition, and we try and look after them as well as we can under these difficult circumstances.
Humphrey, what does that mean? And you were saying, for example, some of the, there's flexibility in terms of pricing packages and things like that. What more do you have to do to I guess, adapt to this new reality, which is quite hard in the UK?
Well, we have very flexible pricing in the UK. We charge different prices for different gyms. So we can tune the pricing to the demand in any market. So if demand shifts a little bit, we can drop prices to make it more attractive for people to come in. And if demand's very strong, perhaps in a residential suburb, then we'll capture a little bit more revenue from that. And what we've done specifically is we've rolled out to pretty much all our facilities in the UK, and we'll be doing this across Europe as well in time. It's an off-peak saver membership that for 30, sometimes 40% less than the normal rolling monthly rate, people can gain access to the gym at weekends and in off-peak hours during the week. So if they can flex their schedules, they can still get access to good quality health and fitness and an opportunity to be active. And we think that's a good thing to be doing in the current market.
So I know you also want to expand in the US. How's that going? And when's the right time to IPO? Do you need that buffer of being elsewhere where maybe the economy is a little bit stronger to be able to go to the markets and be a public company?
Yeah, it's an interesting question, Francine. We're in the very early stages of our expansion and, frankly, experimentation in the US. It's a very different market. So we've committed an amount of capital, but not for us a huge amount. We've got 3 really good sites in and around the Washington, D.C. area where we're learning an awful lot. They've been open about a year now. They're progressing nicely. And we'll continue to look at developing that portfolio and potentially looking at some franchise partners in North America as well. We think that would be a very interesting way of expanding there, but it's in the experimental I often call it the R&D sort of phase in the US at the moment.
So what have you learned so far? Do Americans work out differently to the Brits?
Well, interestingly, I walk into our facilities in the US and guess what? They look and feel much like our facilities in the UK or in Switzerland or elsewhere. The fundamental needs that people have are similar. There are some differences in parts of the equation. Americans, our sites in the US markets have tended to ramp up a little bit more slowly than in the UK, but part of that may be due to the time in which we launched in the kind of post-COVID era. We actually had most of the sites when Omicron was still happening. So we're still learning lessons and trying to interpret those over time.
What did you learn about the company, Humphrey, in COVID and lockdown? Because I know it was such, when gyms were closed, it was such a difficult period. But do you think it's made you more resilient as a company for what's to come?
Yeah, that's a really good question and point, Francine. Without a shadow of the doubt, it's made us more resilient. Look, we'd taken 10 years to build this business, and we were given 10 hours by the Prime Minister to close it down. In many of our gyms, we didn't even know where the keys were because we'd never closed them before, because we operate 24/7, 365 days a year. So it was an absolute sort of revolution for us. And I think in tough times, really find out what you're made of individually in terms of resilience and collectively as a team. And I think we proved through two and now a third through 2022, very tough year, that the business is strong and resilient and has an excellent model. And that the team is not just a good times team, that the team is capable of acting in the most difficult management environment. In 30 years in business, I haven't seen anything like the last 2 or 3 years, incredibly testing, and I'm very proud of the resilience that the team and the business has shown in that regard. We're still fighting our way back, we recognize that, but we've demonstrated that we're capable in dealing with the toughest things that can be thrown at a management team, I think.
Humphrey, thank you so much for, first of all, coming on, and good luck also with the people that want to get fit in January. A lot of people are also doing dry January, which to me sounds like a terrible idea, but each to their own. Humphrey Cobbold, their Chief Executive Officer of PureGym. Let's get straight to your Bloomberg Business Flash now. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. The EU is moving towards a requirement for masks and pre-flight COVID testing on travellers from China. A Commission spokesman says a strong majority of countries back tests, which would go beyond what EU health authorities did recommend last week. Any change will need to be approved by EU ambassadors, who are actually meeting later today. Chinese regulators have approved a plan by Jack Ma's Ant Group to raise $1.5 billion for its consumer unit. The green light is a sign of progress in the fintech firm's government-ordered overhaul, which will leave Ant controlling half of its shares after the deal. The University of California is investing $4 billion in the massive Blackstone Real Estate Income Trust. The fund has faced higher redemptions in recent months and been forced to limit withdrawals. Blackstone has sweetened the deal by earmarking a $1 billion backstop to help the university get a minimum annualized return of 11.25%. And that's your Bloomberg Business Flash. Francine.
Leanne, thank you so much. Coming up, Bloomberg MLive's team are betting against the dollar this year. We discuss why next. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, as much as 2022 is about the dollar reigning supreme, this year will be about the yen, the pound, and the euro dominating the list of winners. Now, that's the view of Ren Ram from Bloomberg's MLive team. So, Ven, first of all, it's a bit of a contrarian call that you have. So walk us through what you expect on G10 currencies this year.
Morning, Francine. It is indeed a contrarian call, if not an outright foolish and bold call. But, the point is, real rate differentials underpin some of the bigger moves that we saw last year, especially for the yen, where we saw real rates move some 350 basis points north to favor the dollar. Some of that is going to come off this year, primarily because the Fed is going to stop raising rates once it gets to 5.25, and the BOJ is going to tweak its curve control yet again. And therefore, I think that the dollar will surrender some of its gains, and currencies like the euro, the pound, and the yen will stand to gain this year.
So, Ven, why do you expect the pound, for example, to strengthen as much as you think it will?
The pound at the moment, it captures a lot of gloom at 120. We've already priced the recession and a lot more. And I do think that, the inflation imperative for the BOE just doesn't go away. We have just seen news that the food inflation in the UK has hit a record. So the BOE has got, because they didn't act emphatically enough earlier on in the cycle, they will have to do they've got tremendous work to do in the back end of the game, and therefore they will have to keep raising rates much longer than the Fed and probably even the ECB has to do. So, and therefore that will push up the pound. And I do think that the calls for a recession are overpriced and overblown, because I do think that we will muddle through 2023 in the UK, but it's not going to be as deep a recession as many fear.
So, Ven, what could go wrong with your outlook?
A lot could go wrong with the outlook, particularly inflation, how inflation evolves in the US and what the Fed's response to it is. If inflation in the US is sticky around 5 to 7%, the Fed is hardly going to say, okay, let's start cutting rates even in the face of a recession, because their primary goal is to make sure that inflation converges to the 2% target they are targeting. And if there's signs that inflation is sticky and the economy is a lot more resilient, then the dollar will be bid all over again.
So, Ven, if you look at, we had some French inflation today, unexpectedly slowing. Do you think bond prices are misinterpreting some of the data out of the Eurozone?
Absolutely so. Because in the ECB, we heard yesterday from the ECB speakers that they're looking at two more significant rate increases. That means February and March is another 50 basis points each. That will take the deposit rate to 3% already. And if you look at the 2-year German yield, it's at 260 now. So that is nowhere in convergence and in consonance with where the ECB is going to go. And if the ECB is targeting real positive interest rates, net of inflation, the inflation projection of 6.3% for this year, we are nowhere near positive real rates. So therefore, ECB rates will have to go a lot higher, and with it, the euro will climb, and German yields will also climb higher.
All right, Ven, thank you so much, as always, for some of your insights and, of course, some of your thoughts. You can also find Ven Ram not only on our live blog, but also on the Bloomberg terminal, Bloomberg's MLive Ven Ram. Now, this is a picture overall for some of the markets that we're looking into. It is one thing that we're watching out for today. This is the Fed minutes to reveal the source of inflation, anxiousness that's pushing up rates. Now, Jay Powell did tie pessimism on the outlook for price to labor strength. We'll see if that's confirmed, of course, from the minutes today. Bloomberg Surveillance Early Edition continues in the next hour with Matt Miller, Kailey Leinz in New York, and Anna Edwards in London. This is Bloomberg.
This policy U-turn on zero COVID, which was executed on 7 December, will raise a whole series of questions in Chinese political circles about the fallibility of Xi Jinping's political judgments.
The global economy has never experienced anything like that. That level of uncertainty in the persona of one human being.
If China reopens forcefully and fast, you could see a bit of a replay of the commodity-led inflation which we had coming into this year or the last year.
This is Bloomberg Surveillance Early Edition with Anna Edwards, Matt Miller, and Kailey Leinz.
It's 10 a.m. in London, 5 a.m. in New York, and 6 p.m. in Hong Kong. Our top stories today. Inflation in France unexpectedly slows last month. That takes some of the pressure off, perhaps, policymakers at the European Central Bank. China plans to shore up its too-big-to-fail property developers. Banks will be encouraged to boost the balance sheets of systemically important real estate firms. And chaos on Capitol Hill. Republicans will try again today after Kevin McCarthy loses 3 attempts to become Speaker of the House. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller and Kailey Leinz in New York. Plenty of chaos in Washington then, Kailey, which we will no doubt talk about this hour. But in terms of market moves, markets very focused on some of the news lines, and there are plenty of those coming out of China.
Yeah, there were a number of positive reports from China, at least in terms of what it did to risk sentiment, Anna, broadly leading to an update for Asian stocks. But Hong Kong really is what led the charge. The Hang Seng Index was up more than 3% on the day. Now, one of those positive news stories is that China is considering stepping up support further for property developers. That really aided risk sentiment as a whole. But there also were some more specific stories, including Alibaba. Those shares rose nearly 9% in Hong Kong after a report that Ant Group has won approval for a $1.5 billion capital raising plan for its consumer unit. So that lifting those shares. And of course, that's a very large stock. So that helped lift the broader market as well. Then you had a separate report, Bloomberg reporting that China is considering easing the ban on Australian coal imports that has been in place for more than 2 years. So that had a big impact in foreign exchange, specifically for the Australian dollar. Aussie dollar trading at 68.72 right now, 68 cents to the U.S. dollar, up more than 2%, now at its strongest since September. That really leading the move in G10, but every single G10 currency is stronger against the dollar today. It is a weaker dollar story. And then in the bond market, we have seen yields moving dramatically lower. Really saw that in treasuries yesterday, and follow through from that in the Asia Pacific overnight. The 10-year Australian yield fell 10 basis points on the day, Matt.
All right, I'm looking at S&P futures, Kailey, that are gaining right now, just about 0.4%. We were down about that much in the cash trade yesterday, and today is the last day for an official Santa Claus rally to pull through. In 1972, Yale Hirsch wrote in the Stock Trader's Almanac that the Santa Claus rally is the last 5 days of the year, plus the first 2 days, trading days, of January, and the average gain, at least then, was 1.3%. So we'd have to gain about 1.25% to get our fair Santa Claus rally this year. The 10-year yield coming down, so offering a little bit less competition to stocks with the yield at 3.69. But of course, that is money going into treasuries that could be going into equities. NYMEX crude is off more than 2%, 75.30 a barrel. So this could be the concern that China's economy really isn't going anywhere fast, although we had a number of stories about China helping its developers that we're going to talk about, I'm sure, today. On the other hand, not putting as much money into chips. I don't know how that could feed through into crude, but I just thought I'd mention it. Bitcoin, I was going to take Bitcoin off this board, but I left it off. It's still 16,000 and change, right? $16,835. Kailey pointed out yesterday to me a story by Joe Weisenthal that shows even at this level, Bitcoin is still up and a 1.69 billion % since its first quote. So not bad.
Right. Since its first quote, okay, if you were in really at the beginning, then that makes sense, Matt, which I know many people might have been. This is what we see on European equity markets. Matt's obviously been doing his homework as to the phenomenon surrounding the man in red and whether he really can deliver any kind of Santa Claus rally. Well, we were here yesterday, weren't we? We saw European equity markets doing positive things about this time yesterday, and that didn't really give us much of a sense of where US markets were heading. Later, it was Apple and Tesla and the like that weighed us down. But let's have another go at it, shall we? European equity markets are on the rise today, up by more than 1%, up by more than 1.4% on the CAC Heron. What we do see, though, is a divide around Europe based on the sector exposure. And one sector that's doing really well today is consumer discretionary, in particular the luxury goods. I could have picked Burberry, I could have picked a number of other names, but I picked LVMH as it was the best performing earlier on today, up by 3.3%. And this has to do with a number of policies, as Matt mentioned, and Kailey also, a number of policies coming out of China that do seem to be pro-growth, whether that's to do with Ant Group and consumers there, or whether it's to do with not the chip sector, the property sector, or indeed a number of other areas. We are seeing some pro-growth policies coming out of China, and that's weighing up to something positive for luxury goods. On the other hand, oil prices are down by more than 2%, and that is weighing on energy stocks in Europe. So that sector down by 1.6%. Here we've got the influence of the inflation print we had out earlier on, and we'll get more details from Danny on this in just a moment. But the inflation number coming in lower than had been anticipated, and as a result, we see yields dropping. Does this change our thinking around the ECB, or is this in line with ECB thinking? That's a question for later, perhaps. The euro may be benefiting a little bit from weaker dollar, 106.11, up by 0.6%, in what is broadly a risk-on environment then, Matt.
It's interesting. so the euro rising here and stocks are rising. Basically, I think a lot of it is tied to that inflation data that you mentioned, Anna. So not really coming in as strong as expected. We saw that in France, unexpectedly slowing inflation in December. We saw that in Germany, of course, the story out yesterday. And last week we had a story out on inflation in Spain, also coming out slower than expected. That should augur well for the ECB or for stocks, right? Because they don't have to raise rates maybe as much as they would have. Although inflation is still a huge threat, I see that we're expecting Europe-wide 9.5% print in December, a slowdown from the 10.1% that we saw in November. Danny Berger joins us to talk about what's prompting that slowdown. Danny?
I mean, a lot of factors, Matt. You went over a lot of them. And yes, everything is slowing. They're slowing for consecutive months. A lot of this has to do with the energy story in Europe. Natural gas, Dutch front-month futures are back at the levels they were before Russia invaded Ukraine. So that is allowing some ease, along with some government help to pay the bills. But I will say there's just so much caution around this idea that this is enough to have the ECB back off. Even in recent days, we keep hearing from policymaker after policymaker saying that we are worried inflation expectations are getting entrenched. Nagel, for example, saying that, look, one piece of data does not make a trend. We need to be aggressive. We need to be forceful. So sure, these figures are lower, again, partially thanks to energy, but that picture's uncertain, as are things like labor unrest that can add to the inflation fuel.
Okay, Danny, good morning to you. So we see some reasons to be a little hopeful about inflation coming off recent highs then in Europe. What does all of this mean for US prices and the US inflation dynamic?
Well, certainly different drivers, but there are some similarities, right? We have gotten some softer prints. There was, of course, that December CPI, which markets got extremely excited about. But to sound like Nagel here, one inflation print doesn't make a trend. Break-evens have fallen. Part of that also might be that energy prices in the U.S. are also low. Oil prices are low, too. But really the concern for the Fed, more so than the ECB, is how tight the labor market is, that could continue to feed into demand-driven inflation, which is what our Bloomberg economics team and Anna Wong believes will happen, that household balance sheets will be strong, atypically strong, and that means inflation will be well above the Fed's 2% target for the whole of 2023.
All right, and we're waiting for those Fed minutes later on this afternoon. Bloomberg's Danny Berger, thank you so much. Let's turn to the China story or stories now. Bloomberg has learned that China is considering steps to further support some of its too big to fail developers. That's as the ongoing property downturn has led to a liquidity crunch. The aid could include equity financing and loans, enabling creation of real estate investment trusts and driving acquisitions. Joining us now is Lulu Chen, Bloomberg's investing and real estate editor in Hong Kong. So, Lulu, what's prompting this latest move?
Well, China wants to avoid a disorderly collapse of the property market, which could spill into the larger financial market. In November, the government set the tone and issued its most sweeping package of policy support measures. What we're seeing today, the trickle of positive news coming out of the country, that's a follow-up on these policy measures, in addition to bolster the property market that we continue to see plummet in December, and also housing sales continue to accelerate their drop in December. So with these policies, hopefully we'll see a turnaround early this year.
Okay, so that's the property sector. We had a number of news lines out when it comes to too big to fail developers and also private equity and their ability to put money into real estate. Meanwhile, Chinese officials are discussing easing a ban on Australian coal, Lulu. So when you add that and you add up the property news, it's starting to feel quite growth positive. What's driving this particular change?
It does seem that the Chinese government has shifted its focus on driving the economy and refocusing on the economy after the Party Congress. And this softening of stance and the warming and improvement in relationships between China and Australia is part of a broader trend where China's foreign ministry has also improved its relationships and its stance against the U.S. as well. For China, there's another aspect as well, which is to secure its energy supply, and that's why increasing imports from Australia would help with that.
All right, Lulu, thanks very much. Bloomberg's Lulu Chen talking to us about the China story this morning. Very much moving markets. Let's get back, though, to the U.S. It was chaos on the House floor yesterday. In 3 rounds of balloting, Republican Kevin McCarthy couldn't get the votes he needed to become House Speaker.
Today, is it the day I wanted to have? No. I mean, there was a lot of things we wanted to do. We wanted to repeal 87,000 IRS agents. We wanted to set up a number of investigations we had going. We wanted to notice the different committee hearings we'd have actually on the border. None of that got transpired. But if we're able to work out our differences and take this time, we'll only be stronger to be able to accomplish the things we want.
Emily Wilkins, Bloomberg government reporter, joins us now in D.C. So, Emily, what are we likely to see today when the House votes again? It's only the first time in 100 years that a majority leader hasn't gotten through on his first vote.
It really is a historic moment, and it's also just a moment that underscores how the next 2 years are likely going to play out in the House. Just the level of chaos that we are seeing, this last-minute scramble to negotiate and to bargain, really raises a lot of concerns for what this is going to mean for other must-pass bills. But as far as today, we're just expecting more votes for Speaker. And at this point, Matt, it's really difficult to see how this logjam is actually cleared. The members who have voted against McCarthy, there were 19 at the start, then their numbers grew to 20. They've said that they still want more concessions for him, on some of them on these House rules, and think of that more as the power in the chamber. These members want to have more power as proceedings go along. And a lot of folks will say, sure, some of the things they're arguing for, these transparency measures, they really do think they are positive things to come. But remember, the more power that go to the rank and file members, the more difficult it can be for leadership to actually get things done. And that's really the core of the trade-off here. And you are seeing increasing frustrations among Republicans toward those members who are still holding out, saying that they're preventing them from getting their agenda done, that they're bringing chaos into the process. There's just really a lot of tension right now, and it's just not clear how this gets resolved.
Okay, so Emily, let's talk about some of the specific things that need to get done, like raising the debt limit. Does this just increase the probability that the U.S. is in a default scenario?
I would say this absolutely raises the concerns that the U.S. could wind up defaulting on this. Not only does it show that there is a small but powerful and persistent fraction of Republicans who are willing to hold out to get what they want to get done, but this entire process has weakened Kevin McCarthy's hand. Even if he does become Speaker at the end of the day, he's not going in as a powerful, united candidate with this conference behind him. He's going in as someone who has had some serious issues trying to get everyone together. So I'd say that absolutely raises concerns for Republicans just in terms of passing the debt limit, passing their other priorities, keeping the government open. All of these things are things that need to be done. And I think there's just a huge question mark at this point whether they can deliver.
All right, Emily Wilkins of Bloomberg Government. I know you had a very long night, so thank you for waking up early for us this morning. We really appreciate it. Now let's move from politics back to the markets and take a look at some stocks moving in pre-market trading in the U.S. And of course, the one we all have been watching for some time now is Tesla, coming off of its worst year on record in 2022 with a 65% annual decline, then started 2023 off yesterday with a 12% drop because of concern around the fact that they missed deliveries once again. But it seems like we are seeing some buying of the dip this morning. We know Kathy Wood is buying the dip. ARK Investment Management yesterday purchased about 176,000 shares of Tesla. That stock is up about 2% before the bell. Another stock that we watched mega cap-wise yesterday was Apple, as its market value fell below $2 trillion. The stock down more than 3% yesterday, but also seeing a rebound this morning. Apple right now up about 1.2%. One big tech stock sitting things out, though, this morning is Microsoft. These shares are actually down about 2% after getting downgraded over at UBS. The analyst there citing concern about growth in the cloud computing business, that Azure cloud business, cut his price target as well to $250 a share. This morning, it's trading just shy of $235, Anna.
And talking about what's coming up on the programme, then we move on from those specific names, Kailey, to the macro. Holger Schmieding joins us, Berenberg Chief Economist. We'll get his take on some of that inflation data we discussed earlier. What difference is that making to his assessments of the ECB and relative rates across the Atlantic? And on the showdown in the House, Terry Haynes joins us from Pangea Policy. He's going to give us his thoughts on how significant or otherwise this is for markets. This is Bloomberg.
Welcome back to Bloomberg Surveillance, the way too early edition. We are simulcast on both Bloomberg Television and radio. And I'm watching the dollar today. It has come down considerably from the all-time high that we saw in the BBDXY just a couple of months ago. 1353 was the reading there. But so have leveraged fund net dollar positions. So bullishness coming off of its 2022 peaks and really looks like a cliff edge. Joining us now to talk about this is Ven Ram, Bloomberg Markets Live strategist. So Ven, what do we replace King Dollar with? Is it all about the yen? Does the pound get hurt more than other currencies? What's your take as we kick off 2023?
Morning, Matt. Your chart says it all there. I think that, the yen and the euro, the pound, and the Canadian dollars are going to be some of the stellar performers for 2023. Why do I say that? Because if the Fed stops raising rates once it gets to 525, which is the level they indicated in the dot plot, then I think real interest rate differentials will begin to narrow in favor of these currencies, and therefore they will do well.
Okay, so that bodes well then for the yen. I can see that for the yen and for the euro, given policy, and to some extent for the pound, given policy. But we know that the UK faces a number of headwinds in terms of other policy-making areas, Ven. So when you say positive for the pound, is that because of UK specifics or just as a function of dollar weakness or euro strength?
It is predominantly because of euro strength. The pound has been behaving like a euro derivative, and therefore any strength in the euro, the pound will absorb in excess of it. If you look at the pound, it has surged some 17% since the lows of the last year. And that is an impressive rally. And all along that period, the markets have always known that the UK economy is going to muddle through 2023. So what is that ebullience because of? That ebullience stems purely from how the euro has behaved. Also, we can't forget that even though the UK economy is going to muddle through this year, the inflation narrative is going to be predominant for the BOE, which means that they won't be able to stop raising rates, even in the face of a slowdown. And that will support the pound as well.
Ven, we just had a question come in via IB from a viewer. How are you feeling about gold?
Well, I think gold has some upside, because if the Fed is going to stop at 525, then gold will be bid, because all through last year, when the Fed was raising rates, gold showed its convexity, which means that when rates are going up, you would expect gold to fall, but it didn't happen really to the extent that you would have expected. And why was that? That was because convexity came to the rescue of gold. Now, convexity works both ways. So if it's not going to lose a lot when rates go up, it's going to gain a bit more when rates go down, and it's a bit of a heads you lose, tails I win kind of scenario, and that is perfect for gold.
Okay, we'll watch that then. We'll watch the precious metal. Ven, thank you very much, Ven Ram of the Bloomberg Markets Live team. And you can check out the thoughts of the MLive team. MLIV Go is the function to use on your Bloomberg terminal to keep across the Markets Live blog. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Kailey Leinz with Matt Miller in New York and Anna Edwards in London. Now, keeping you up to date with news from around the world, here's the first word. The Federal Reserve is about to shed more light on why it's worried that strong inflation may linger. Today, the Fed will publish minutes of last month's policy meeting. At the end of that meeting, Fed officials published new projections showing they expected inflation would end 2023 higher than they previously thought. The European Union is moving toward requiring COVID tests for travelers from China. EU health advisors have agreed on a draft opinion that includes masking and pre-flight testing requirements. Several European countries, including Italy and Spain, have already imposed testing rules on flights from China. FTX founder Sam Bankman-Fried now faces a trial in October on the collapse of his crypto empire. In a court in Manhattan, Bankman-Fried pleaded not guilty to criminal charges. U.S. prosecutors say they expect to produce all the evidence for the case in the next 4 weeks. And it's another policy shift at Twitter since Elon Musk took control. The company will relax a 3-year ban on political advertising to, quote, facilitate public conversation around important topics. Further details will be announced. Twitter imposed its ban in 2019, saying that political message reach should be earned, not bought. And coming up, we'll go back from politics to macroeconomics and talk about The softening in inflation data we're seeing in Europe preview the Fed minutes later on this afternoon. Holger Schmieding, Berenberg Chief Economist, is joining us next. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. Here's what you need to know. Inflation in France unexpectedly slows last month. That takes some of the pressure off policymakers at the European Central Bank, perhaps. China plans to shore up its too-big-to-fail property developers. Banks will be encouraged to boost the balance sheets of systemically important real estate firms. And chaos on Capitol Hill. Republicans will try again today after Kevin McCarthy loses 3 attempts to become Speaker of the House. I'm Anna Edwards in London with Matt Miller and Kailey Leinz in New York. And Matt, European equity market's not doing too badly today, but we said that this time yesterday, and it didn't really tell us much about which way the U.S. session was going to go.
Yeah, no, there has been a lot of volatility, I guess, to kick off 2023. Maybe today we'll see consistent gains. We haven't really had much of a Santa Claus rally, so we're going to have to start looking to other measures for the stock bulls. But we do have, right now at least, are we 4 hours away?
Yes.
4 hours away from the open, and we're up 0.4%. As you said, Anna, that could turn around and often does before we get much deep into the cash trade. I wanted to show a couple of commodities here. NYMEX crude is down considerably, 2.25%. I think that's very interesting. 75.23 for a barrel of West Texas Intermediate crude, and this just, I guess, shows investors' concerns about the COVID spike in China and how much that could hinder a pickup there in terms of gasoline purchases. Gold is up 1%. We're looking at $18.58 a troy ounce. It's come up considerably. If you look at the chart, it's really interesting because, when we were less concerned about inflation, it was rising. As inflation became the real boogeyman, it was dropping. And now that we're talking about, getting close to a terminal rate for the Fed, it's leveling out and coming back up. And then the 2s, 10s, buddy of mine, Anthony, who watches the show, suggested I use this to replace Bitcoin. As the spread starts to go back down again, we'd seen a recovery in this inverted spread, right? But now it's getting worse again. What does that say about the economy, especially as it looks like the U.S. government is having trouble electing a Speaker of the House? Kailey, what do you see in terms of the pre-market movers?
Well, I'm keeping an eye on some of those mega cap tech stocks. They're definitely less mega cap than they were because both of these names, Tesla and Apple, have seen their market valuations come in substantially over the course of the last year or so. Tesla, of course, being down 65% in 2022, then starting off 2023 with a 12% loss. A lot of concern about demand after weaker deliveries numbers were posted over the long weekend. But buying of the dip coming in. Kathy Wood is one of those participants, but others seem to be as well, with Tesla up about 2%. So a little bit of a recovery before the bell this morning. Meanwhile, Apple, after falling below $2 trillion in value, also rebounding to the tune of 1%. But outside of U.S. tech, Chinese technology stocks also ones to watch. We saw a big rally in the Asian session overnight. Alibaba was up about 9% in Hong Kong. That is continuing in the ADRs here in the U.S. Alibaba's up about 6.7%, and JD.com higher by nearly that much as well, Anna.
And Kailey, here on European equity markets, we're doing pretty well, up by just over 1%. If there was any macro signal in what we heard from Tesla or from Apple yesterday, then it's certainly not pushing into the European session and weighing on sentiment here. Instead, Kailey, we're picking up on what you mentioned there, some of the more optimistic news flow surrounding China, whether it comes to the property sector or to the coal sector and what they're planning to do with Australian coal. All of that adding to sort of some growth positive policies, which means Europe goes higher and is led by consumer discretionary goods, luxury goods in particular. So luxury stocks are moving higher, up by 3.8% on LVMH. I could have put in a number of other names, but that's one that is certainly on the move this morning. To the other end of the spectrum, and what is weighing on London, is what's going on with energy stocks, down by 1.9% right now, as we see oil prices retreat by, earlier on today, 2%. And so as a result, we see weight on those types of stocks. The French 10-year yield, we're seeing the yield coming down. I put in the French yield because we got French data on inflation earlier on, which came in weaker than had been anticipated. But I could have put in German yields, Italian yield, all these yields across Europe falling. There seems to be a bit of an assessment, misplaced or not, that this makes a difference for the ECB and the extent of the hikes that we still need to see from the ECB, Matt.
Yeah, it'll be interesting to see if we get another big move from the ECB, or as inflation seems to slow down if they can kind of chill out a little bit. Joining us to talk about that and the rest of the global economy is Holger Schmieding, Berenberg Chief Economist. Holger, I did notice, or we have been noticing, a trend in terms of European inflation coming in lighter than expected in France, in Germany, in Spain. Does that mean that the ECB can kind of calm down in terms of the rate rises?
It probably does not mean that. The inflation data at the moment are volatile. They're distorted, for instance, in Germany by a one-off payment. And the European Central Bank for now is determined to bring inflation down much, much more. So what they have de facto told us in December, 50 basis point rate hike, in February, 50 basis point rate hike, a steady pace, as they call it in March, that is likely still to come. What these data do, however, support is our call that beyond the 100 basis points that have been de facto pre-announced, the ECB will then probably be on hold instead of going further.
Good morning to you, Holger. Good to see you. So that's your read across into the ECB and what it does to the thinking there. I mean, one of the best news stories for the Eurozone over the winter must have been the weather, basically, and the ability, therefore, for Europe to build up and keep its storage of gas at relatively high levels. Does this give you reason to be comforted about this winter? How worried are you, though, about the sort of structural energy challenges that still lie ahead in winters still to come?
The very good news is that the a rather comfortable situation which we currently now have with gas in Europe is not just a consequence of the weather, which definitely does help, but it's also a consequence of consumers and businesses are using less gas, even adjusted for weather effects, and also to some extent that we have ramped up our capacity to import liquid natural gas. At the moment, with 1/3 of the heating season, this heating season already being over, our storage facilities are filled so much that we are, in percent of capacity, 12.6% above what is normal for this time of the year. And the experience of the first third of this heating season gives me some confidence that in a year's time, we will also be able to cope. After all, our engineers will have another 12 months to make further adjustments to reduce the consumption of energy and in particular the consumption of gas, which is no longer quite as expensive as it used to be a few weeks ago, but still is expensive.
Yeah, that's going to be fascinating, isn't it, to see how Europe can cope with next winter and how all of these challenges are managed in terms of energy needs. What about the role of China in 2023 then, Holger? There seems to be a lot of competing dynamics in China right now. There's the COVID reopening story, seemingly quite positive perhaps for the economy. Of course, the human toll of that as yet unknown. And then lots of other policy initiatives that seem to be supportive around property, around big tech. We can point to these, and around coal. Just in the last few days, some pretty positive announcements. What kind of role do you expect China to play?
There's a lot going on in China, but I do not expect China to play a major role for the European recovery. China will probably have a rough winter now with a surge in COVID cases, which could have some impact on supply chains temporarily. But we are already having a winter recession in Europe, so that will not add much to that. And later this year, probably China will be back on a growth track, moderate growth around 4%. The stimulus is not as effective as it used to be in the past. So I expect China to be neither a significant drag nor a significant driver of the European recession, followed by the European rebound.
Okay, Kailey.
Holger, we've talked a lot about inflation, but here in the U.S., when we are thinking about the Federal Reserve, it seems a large part of the focus has shifted away from inflation and just CPI figures to the labor market data, which has proved incredibly resilient. So ahead of JOLTS later today and jobless claims tomorrow and ultimately the December payrolls report on Friday, what is your read of the persistent tightness of the labor market and what it's going to mean for the Federal Reserve as it tries to create some slack?
You're absolutely right. What we need to see in the US is that wage pressures are easing. So far, the evidence on that is mixed, to put it mildly. And hence, before we talk about a Fed pivot, which may come, and we do expect a rate cut late in the year, we will have to see clearer evidence that in the US the labor market is softening, that is translating into wage inflation. But we may be a bit away from that for now. For the US, the Fed will likely still send some hawkish messages, will likely still go ahead with, say, 3 25 basis point rate hikes to come, and then go for a pause rather than a pivot until late in the year the labor market data are convincingly weaker and thus underpin a pivot.
What does it take, Holger, to turn the Fed around? Is it just weakness in labor markets? Do you need to see something break in the credit market? For example, a jump to 9 or 10% defaults, would that do it?
That would probably not the issue for the Fed to address with rate policy. That would probably require other interventions in markets rather than changing the overall course of rate policy. Remember, we have seen it in the UK in the wake of Trussonomics, that the Bank of England reacted with a very targeted intervention rather than with a rate cut to get over the temporary financial turmoil. So we need to distinguish between what is the policy response in order to get inflation under control and what could be the more temporary emergency responses to specific situations, which I very much hope will not erupt in credit markets.
Holger, thanks very much for your time. Holger Schmieding joining us there from Berenberg. When we return, we'll talk about US politics. Chaos in Washington yesterday, a failure to elect a speaker yet. That battle continues today. We'll talk to Terry Haynes, Pangea Policy founder. That's next. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. You're looking live at the Principal Room. Coming up later today, an interview with Morgan Stanley Chief Economist Ellen Zentner. That's at 12 p.m. in New York, 5 p.m. in London. This is Bloomberg.
No persons having received a majority of the whole number of votes cast by surname, a speaker has not been elected.
The clerk of the U.S. House of Representatives speaking after Republican leader Kevin McCarthy failed to win the speakership. A small group of party dissidents delivered a stunning political rebuke to the California Republican that previews potential turmoil in the chamber over the next 2 years. Joining us now to discuss is Terry Haynes, Pangea Policy founder, up early for us this morning. Terry, let's just game out different scenarios here. What probability do you assign to Kevin McCarthy actually being able to pull this off? And what probability that someone else is going to have to step up to try and unite the party? And who would that person be?
Good morning, Kailey, and Happy New Year to everybody there. I have never been somebody who thought that McCarthy had much of a chance of pulling this off. I was about 55%, which in market terms is, of course, not a vote of confidence. I see it as much lower the longer this goes. I think that what's going to end up happening is that, and this is very much gut on my part, I should say, is that the House turns to either a more reliable conservative, somebody who is not McCarthy, but yet not one of these 20 or so people that have been consistently voting against him, or alternatively, they turn to more of a centrist person that is acceptable to all the factions. But it's very clear at this point that this is a not McCarthy sort of movement, and there's a lot of vanity here on both sides, and one of the vanities is that only McCarthy can do this, and of course that's not true. This is not an indispensable man in an indispensable moment. So in the longer term, he's going to have to step aside, I think.
Terry, I want to pick up on one idea you just alluded to, the idea that there's a number of factions within the Republican Party right now. So I wonder how the inability to unite around one leader in the House may also have implications or foretell what could come when it comes time to pick a nominee for the Republican Party in 2024.
Oh, sure. I always think that there aren't two political parties. There are four factions. There are left to right. There are progressive Democrats, centrist Republicans, conservative Republicans. You're seeing two of these factions war right now, but you can always see this in both parties, and how delicately things tend to get stitched together. So you're seeing a factional battle right now. In the short term, let me say three things quickly. Firstly, in the short term, this makes absolutely no difference to what markets already knew was going to happen in Washington in 2023. Domestic gridlock, kind of basic spending agreement at the end of the day. I'll get back to that. And unanimity in foreign policy. I think all those things continue. In the medium to long term, by which I mean sort of 3 to 6 months, though, this scenario, what you've seen play out over the last day or so, means that there is now a rising risk of U.S. government defaults later this summer or into the fall. Very simply because these folks want to use the debt ceiling fight and the need to raise the debt ceiling as leverage to reduce spending, and they'll be willing to engage in brinksmanship to do it. That will provide a significant market negative that'll loom for months.
Terry,
yes, I'm sorry.
I think a lot of people are confused because this Freedom Caucus is painted as kind of an extreme right-wing, hardliner, election-denying, Trump-supporting group of representatives. And isn't that exactly what Kevin McCarthy is? I mean, it doesn't make sense to me that they would not be on the same page. And then I also hear that this Freedom Caucus is asking for, you know, things that seem like very responsible Democratic government, a vote on a balanced budget, a vote on term limits. Those things sound like, you know, something we learned in social studies was the right way to go. So how do I, you know, square this circle?
Both very good questions, Matt. I think the way I would suggest you think about this is that, you know, any politician that is trying to lead a broad caucus with diverse views has to put a foot in a lot of different camps and bring confidence. McCarthy has a lot of confidence from his caucus, but apparently just not enough, number one. Number two, what I'd say to you about the votes and the other things that the purists, the 20 purists want is that, you know, what they're doing is actually attacking their own caucus by doing that. I mean, the idea that they would get to pick their own legal counsels, that they'd get to pick their committee assignments, you know, that actually is a direct affront to the broader caucus and how those choices are generally made. So, you know, what these folks are doing is not looking to compromise. This is very much about McCarthy personally and very much about painting him as a swamp creature. There's an untold story there, and I'm not quite sure where the original sin is. But you know, they're bound and determined to have McCarthy not be speaker, and I think they get that, but they don't win on the other stuff.
Okay, and Terry, I was taking on board all you were saying earlier about how this doesn't change what the market already knew about what government in Washington is going to look like in 2023. There have been some who've suggested that perhaps this could have an impact on debt debates, take us further to the edge, therefore push up borrowing costs or the cost of insurance against U.S. default. Is that some kind of market impact that we could watch for?
Oh, absolutely, Anna. You know, what I've been saying since before all this started yesterday was that, you don't have much change in the short term in Washington here. The same, you have the same sort of factional, no control Congress, marginally Republican House, marginally Democratic Senate, that everybody knew we were going to have anyway. That doesn't change regardless of who's speaker. Where the change comes is that we now have, and will continue to have for a period of months, an increased likelihood that there is some kind of default as a result of the whole debt ceiling debate, and that will shadow markets increasingly throughout the spring and summer, I think. So and impact things like borrowing costs. So that's very much a real-time dividend of the kind of demonstration these 20 folks are making right now, and it is an eventual serious market negative.
Okay, Terry, thanks very much for joining us. Terry Haynes joining us there from Pangea Policy with his thoughts on the politics and where it meets markets. Coming up on the programme, the trial is set. We will discuss what comes next in the case against Sam Bankman-Fried. That's coming up. This is Bloomberg.